Hello, and thank you for joining us for today's webinar, M&A Trends in HVAC, Timing is Everything. My name is Terry McIver, Editor-in-Chief of Contracting Business, and I'll be your moderator today. Before we begin, a few words about this webinar technology. This platform allows our audience to be more involved with the presentation, and more importantly, it allows you to watch this event the way you want to watch it. So to begin, feel free to customize your webcast console. You can move the windows around by dragging on the title bar or resize your windows by clicking on the lower right corner of any window. You will also notice a toolbar at the bottom of your console. These buttons allow you to open and close widgets on your screen. If at any time you experience difficulties with the audio or advancing of the slides, simply press your F5 key to refresh your webinar console. We also encourage you to ask questions at any time by using the Q&A widget on the left side of your screen. We will address as many audience questions as possible at the end of the presentation. We really appreciate your feedback, so please click on the survey icon and complete the form as we near the end. And now I'd like to introduce today's presenters. Dina Jalbert leverages nearly 20 years of success in building, scaling, and buying and selling businesses to accomplish her clients' goals. A CPA and MBA, her career experience spans many years in Big Four public accounting and consulting firms, in addition to holding executive positions with Fortune 500 and hyper-growth middle-market companies. As an M&A expert, Dina has facilitated nearly $1.5 billion of buy and sell-side transactions, including acquisitions involving companies such as Visa, Bank of America, Hewlett-Packard, and Google. Prior to founding Align, Dina served as the CEO of an HVAC contractor, and her firm has facilitated over $150 million in HVAC M&A transactions across the country. Dina has been recognized as a leader in her field, earning distinction as a rising star of M&A by M&A Advisor magazine. She and the firm have been featured in top-tier publications such as Fast Company, Inc., and Entrepreneur, and Align was named the best mid-market M&A consultancy in the Southeast in 2019. Jeff Pearsall is an M&A specialist, having conducted over $100 million in transactions, and directs the HVAC efforts for Align. As the former CEO and founder of SCB Marketing, he is a proven leader in all endeavors of his life, having positively affected tens of thousands of people throughout his career. He is an in-demand international speaker, recognized for his authenticity and relevant messages. Co-author of Dogs Don't Bark at Parked Cars, an informative business and personal development book addressing the hyperactive change we are experiencing in society today and how to deal with the uncertainties. A former award-winning college basketball coach, Jeff inspires, motivates, and celebrates entrepreneurs and leaders by connecting business owners with real opportunities for profitable growth and exit. He makes the chaos manageable. And with that, let us begin. Over to you, Dina.
Well, great. Thank you so much, Terry, and thank you to Contracting Business for the opportunity today. Thank you to all of you who've carved out time in the day. I know that afternoon is a tough time, so thank you everyone for making the time. I hope you find what we have to chat about today helpful. Some of the things that we're going to talk about today revolve around kind of 4 key objectives. We're going to focus on strategy. We're going to talk about market trends, valuation trends, deal trends. We're also going to talk about terms. And lastly, everyone's favorite topic, we're going to talk about due diligence and how to set ourselves up for success in an M&A transaction. So first, to set the stage, wanted to take an opportunity to talk more about lower middle market businesses and the M&A market conditions that exist. So lower middle market is technically defined as businesses that have revenue that are less than 100 million, anywhere from $1 million to 100 million, somewhere in that large range there. And the market conditions for M&A are unique to this specific demographic of business, of which your contractor-based businesses such as HVAC. I know we've got many different types of organizations on the line today, everyone from HVAC to plumbing, electrical, broad mechanical contracting, but all of those verticals all tend to fit in this lower middle market demographic. And so market conditions right now are really strong. Deal activity is strong and it is anticipated to remain strong. One of the questions we get asked often, though, especially in the times that we're in today, is, is that really true? It seems like it's a terrible time for M&A, but actually lower middle market businesses and M&A for those businesses in recessionary times or in times of contraction, there's more demand for them. Acquirers, investors who would normally look for larger organizations shift their focus and actually look for opportunities in the lower middle market. So there's a lot of demand. And so there's a lot of macroeconomic characteristics at play. So, valuations remain strong. Succession planning and business succession planning, the baby boomer generation is shifting and nearing retirement. And so with that comes the need to plan for succession. Many business owners of that generation, their children don't necessarily work in the business, and or they don't want to own it and run it themselves. And so then that leaves owners with a question of where does the business go from here? Lower middle market businesses tend to be in fragmented industries, and HVAC is certainly one of those, and we'll talk more about that a little bit later. And similarly, there's a lot of consolidation that is taking place, both from financial investors and corporations themselves, both of which want to inject capital into these businesses and help them grow. So all of these dynamics are at play right now, which bodes well for lower middle market businesses. Some recent M&A trends that I think all of you on the phone would likely find interesting and hopefully find it exciting and see the positivity, because I know the media these days, when we turn on the news, there's not a lot that's positive. But despite COVID, transactions involving companies that have revenue less than $50 million or transactions that are less than $50 million in value, they're actually on the rise. So through the first half of the year, through the quarter ending June, we don't have obviously the third quarter ending yet, but current trends are all showing that it's been even stronger than the first half of the year. But you'll see, and it's kind of hard to see in the visual here, but those deals are on the rise. They actually were growing over the time. And you also see that the EBITDA multiples continue to grow. And these are specific, to lower middle market businesses, because these are businesses who are need to have businesses, things that individuals and businesses have to have, and therefore are a little less prone to the recessionary or macroeconomic conditions that you might see plaguing some of the larger companies. And then another favorite topic of everyone's is taxes. Everybody loves to talk about tax, but considering where we are in the world right now, and we have an election coming up, capital gains is a topic that many have been talking about. The Biden administration has come out and put forward their proposed tax policy, and in that policy includes a doubling of the capital gains rates, essentially. So right now they're hovering at around 20%, and should that political climate change, it will likely increase the capital gains rates. And so that means that any transactions that a business owner were to go through in the future, it would require almost a 32% higher sales price to receive the same cash proceeds as you would get as if you did a deal today with rates this low. So, you'd have to almost get a third more, which can be challenging potentially, but and it's certainly a very material amount. And so in terms of when you think about what a transaction can do for for you and for your family, you have to really factor this type of tax ramification in. And as you can see in the visual here, it has changed drastically over the years, and you could probably follow the geopolitical standings with each peak and valley, but really we can expect a change here. And so for anyone who's really been thinking about doing something like this, this certainly is a data point that you would want to consider in your overall strategy. The types of acquirers, there are many types, but specific to HVAC, there are two predominant types that have been really focusing their efforts in consolidating the industry. The first being private equity, and the second being strategic acquirers or corporations, larger either public or large private corporations. So as you can see here, the almost 17% of the overall deals that were done were direct investments, new platform investments by private equity. You'll see that almost a third of them were done with strategic corporations that are privately held. Both of those indicate investment for growth. These investors are investing in this industry to consolidate and grow share, and in certain geographies, but then also on a national basis. They're also making these investments to diversify services, which we'll talk a bit later. So, you might start with core HVAC, but then you're adding on plumbing, electrical, and other ancillary services that are complementary, and that can be leveraged for growth. And so that's what we're seeing here broadly, and these are the folks that, as you've been hearing about acquisitions in your space, these are the two groups that are doing the predominance of the acquisitions. Private equity is employing what is known as a buy and build strategy. And what that is as I mentioned before, that direct investment, you'll see that 16% roughly, that is a direct platform investment. That is an instance where they will, those investment firms will come in and invest in a business and create the foundations. When you think about a house, that's the foundation of the house. Then they will do add-ons. So you'll see that almost 25% of deals were add-on acquisitions. So what that means is they buy complementary businesses and consolidate them. And it's kind of like adding floors of the house on top of the foundation. Just with each one, the house gets bigger and more complex. And that's their strategy. The idea being that they grow it into something larger and then look to exit that either to a strategic or to another financial sponsor down the road. So with that brings a lot of growth opportunity. Strategics look to acquisition to improve their market share, to improve their service offering, to grow and to compete with some of the organizations that are being spun up by the financial sponsors as well. So, this is meant to illustrate there's a lot of options and there's a lot of different types of buyers who have different objectives in a deal that would be an interested party in investing in these types of businesses. As we mentioned, the HVAC industry is very fragmented. I don't have to tell all of you that by any means, but interesting data point, there's roughly 75,000 companies in the United States alone in this industry. And that makes it, that's why strategics and PE are very interested in investing, because with fragmentation, with consolidation can come growth and speed to growth. Acquisition allows companies to grow faster versus having to build it themselves. And, what do they look for in consolidation? So they're looking for companies, HVAC companies with recurring revenue, a focus on maintenance and service, ideally with a strong base of maintenance contracts, and a strong regional presence and brand. And so, and that's applicable also to, to our friends on the phone who are industrial and commercial contractors as well. There's a demand for that as well. It's not just residential. But the same mechanics in terms of the construct of the business are very much relate to your business as well. Looking for that construction and installation revenue, but also a strong percentage of your business based around service and maintenance, ongoing repair. So it really applies whether you're residential or commercial or industrial or construction or all of the above. Those themes are what acquirers are most interested in. And, as I mentioned earlier, private equity firms that create these platforms, they want to drive value two ways. One, through inorganic growth, which fancy words for growing through acquisition. And the second being organic growth, investing in the business, things like marketing, fleet, people, facilities, putting capital into business to grow in an organic fashion as well. And add-on acquisitions are the key component of that strategy. And so what they try to do is consolidate in certain geographies, in certain service verticals, and then grow the business from there. So we're seeing this consolidation, especially in 2019. Once we get to that visual, it'll really jump off the page. That's been a real area of focus from an investment perspective.
So thank you, Dina. In 2019, you can see here we had a record year in HVAC consolidation and HVAC investments. Now, there's several private equity groups that have established what we call platform companies in this vertical of the HVAC, plumbing, and mechanical contractor space. And they're in the process of seeking and acquiring add-ons at a very rapid pace. 2020, other than for just a couple months, has been very, very high in its pace, and it's accelerating as we move into the fourth quarter. From a timing standpoint, it's really important to understand that as these platforms mature, which is basically a 5 to 7 year process, it basically means if you miss that timing cycle, you've got to wait on market cycles to return, which is typically a minimum of 10 years from the current time. So you got to look at your planning as it relates to your personal estate and also to the business, and really make sure you're aware of the market timings that are out there and available to you. Now, it is a very competitive landscape, one that, there's been hundreds of deals done that since probably about 2011. These companies now have very strong investment backing to fund their growth. This gives them a leg up on the competition because they're going to experience better pricing models in their insurance, better pricing models in their OEMs. And when an owner actually needs to get another vehicle for their fleet, all they do is pick up a phone and make a call, and then the new vehicle is showing up. So it really does help establish long-term growth. It allows you to really, really take care of your employees because better compensation for good talent is a part of this model. So everything that you think about in terms of the timing to be able to drive with this landscape is set up perfectly for you to be looking at this opportunity.
That's so well said, Jeff. Going back to this visual, I love this particular slide and this chart because it really jumps off the page of the increased interest year over year in HVAC M&A. 2019 was a banner year, as Jeff mentioned. 2020 is continuing to trend strong because the investments made in the earlier years they're seeking add-ons. And so that provides a lot of opportunity. And so you can see here on this slide that these are just a very small slice of some of the logos of some recent organizations who have either been acquired or partnered with financial sponsors. And so you can see that the volume of those types of transactions are growing, as well as it now creates an extra dynamic from a competitive perspective. In your marketplace, your competition is now well-funded. And so as Jeff's analogy about a fleet is a great one. When they need something, they have a partner that has unlimited capital resources to be able to invest and give them what they need. So they can often outspend smaller businesses and be able to take share in an organic fashion at a much faster rate. And so, that's another data point that we like to point out, because as business owners think about their growth strategies and an eventual exit strategy, the timing of that is really important, because if your market is one that's in high demand and there's a lot of investment, there's been a lot of acquisition happening in it, it will make your competitive landscape in your local market tougher for you to compete. And so it's just something to consider as you're planning for the future. Which is a great segue into what everybody asks themselves when it comes to M&A. What's in it for me? Why would I do this? What's my motivation? I run a really good business. I'm really happy. I'm not looking to retire anytime soon. The business could grow, but I don't really want to invest in what it's going to take myself to do it. And so why would I do that, and what's in it for me? And it's really boiling that down into motivations. And there's motivations at different times. When the market is down and when the market is good. As we've been talking about through to this point, the greater macroeconomic world is down, but I think for HVAC in particular, the market is still very buoyant. Again, it's a need to have. I know, we're based here in Orlando. It gets real hot in August and September, and regardless of my personal situation, my HVAC breaks, I'm getting it fixed, and if it dies, I'm getting a new one. So regardless, it's a need to have. Same thing, plumbing, electrical, all of those things they have to have. And so it's a great place to be as a business owner of this industry, because now you really have a lot of positive dynamics at your feet that allow you to have the choice in terms of timing. So, for those that are approaching retirement age, we talked about succession. It's probably you're nearing a time where you're ready to just do something other than eat, sleep, and breathe your business, whether it's other personal goals and objectives and hobbies and things that you want to focus on, or you're just tired. You've been doing it for 40 years and you're ready to hang up the reins. Whatever that motivation is, but time is the one resource that we can't recreate. And so reclaiming your time is a very meaningful and material motivation. Oftentimes the business has grown to a point where to grow it any further would require a real investment of cash and capital, more fleet, expanded geography, satellite offices, personnel, all of those things that it takes a capital infusion to take a business from 10, 15 million up to 75 to 200 million. It takes a lot of investment, and that's where some financial partners, and private equity in particular, is a great partner, because they bring that capital. They bring the ability to do that versus you doing that on your own. So most businesses who are smaller, they don't want to make those types of investments themselves. Go and take a big line of credit and have to do that type of investment. They'd rather someone else do that. And that's a real opportunity for business owners, because there's an opportunity to partner, and we'll talk about this here shortly, but there's an opportunity to partner and participate in that growth. Timing is everything in that. You have to time the market, demand, supply, and right now the demand for investments is extremely high. It's very competitive. So exit opportunities are abundant. Valuations are really strong. Obviously we all, when we think about exiting a business, want to do it when valuations are at their highest, not when they're at their lowest or when there's not as much demand. And so that cycle that Jeff was mentioning before, the timing is really important, because if you wait and you miss this cycle, you're going to have to wait another decade to see it come back again. And so you always want to time that right. But the most important question, I think, if there's anything to take away from today's deck, it's this slide, is what do I want? So when you talk about M&A strategy, it has to start with yourself. 99.9% of businesses in this industry are founder and owner operated. So there's a personal need. What do you personally want from a potential transaction? You need to determine what your priorities are, your make or breaks. These are the things that you absolutely have to have. And so, things that you want to think about. How long do you want to stay on? Are you ready to hang it up and go sit on the beach in Costa Rica, or do you have some more years in you but you want to start with that transition now? So maybe you're not exiting today, you're exiting in 5 years or 2 years. Is there a specific amount of proceeds that you require out of a transaction? This is a really important point because there's wants and needs, as we all know. So it's really important to understand what you need. So if you don't know what that number is for you personally, I would highly suggest consulting with a wealth advisor or retirement planning specialist, someone who can help you really determine what that number needs to be for you and your family, and allow that to be a data point that drives your process. In addition to determining what you want personally, what do you want for your people? What opportunities do you want to present to your people? What future do you want? Do you have a management succession plan? So when we talk about succession, it's less about family, perhaps generational succession, but succession from, do I have a great general manager who's ready to, to just own this, or not own it, but to, to run this day to day and be that leader? Are there family considerations? Are there family members who work in the business, that you want to make sure that you account for? What types of opportunities do you want to present and be able to give to your people, after your exit, and who's the best partner to deliver that for your people? And then the third leg of the stool, if you will, in determining what you want is, what does the business want? Where can it go? Is there growth? You built a great business, obviously, and is there more room for growth? If I always like to say, if given a bag of money, what could you do with that, and where could the business go and grow? What are those? They call them addressable markets, but are there other geographies or other services that are adjacent that you could add? Are there any acquisition targets that would add value to your business? I know that this is an industry that everyone knows everyone. You know those in your market, and so think about that. Think about those that you respect, and that you're like, well, gosh, if we were to be able to kind of combine our efforts, how powerful could we be? Those types of questions you want to ask yourself about your business, or does that not appeal to you at all? There's no wrong answer by any means. It's just really sitting down and thinking about what you personally want. And I would suggest, pulling on experts to help you answer that question, because it's a heady one and not one that can be quickly and easily answered as well. And the point of this is that different buyers and acquirers and investors, they will all provide different answers to the above, because they all have different structures and different growth objectives themselves. And the idea is that you want to line yourself up with the ones that fit what you want and need, because then what you want and need is what they want and need, and everybody's winning. It's where you try to shove the square peg in a round hole, is where maybe you hear some of the horror stories where things don't go so well. And so that's why it's really important to take the time to think through strategy and answer those questions. What do I want specifically? I don't know if many of you have heard of this concept, but there's a concept that is known as the second bite of the apple. And this is specific to private equity and or financial sponsor investments. As I was articulating earlier, private equity makes a platform investment and then adds on other companies to create a larger organization. And then the idea being that larger organization down the road is exited to either a corporation or usually to another financial sponsor, just a larger one. Those who are a part of that platform traditionally are given and are allowed to have ownership in that large entity. So when that transaction takes place in the future, you get to participate in that one as well. So, how it really functionally works is, today you get to monetize your business and sell it, and you'll earn proceeds for today's transaction. But then you'll have the option to reinvest some of that and retain some ownership. And the percentage can vary. It depends on group and individual. It can be as much or as little as you want that to be, but you get to retain some ownership. But that ownership is now in this larger entity. And so, if you own 20% of this larger company, when that sells in the future for 100 or 200 million, you get 20% of the outcome of that transaction. I mean, those are simple numbers. It's different for every circumstance. It certainly isn't guaranteed, but that structure is what you are seeing being employed by private equity investors in the industry. And it's an extremely lucrative and exciting opportunity, because what it does is it obviously provides two sets of proceeds, two earning points in time, but it also establishes opportunity for your employees, because oftentimes a lot of these groups allow employees to participate in that as well. And they get some ownership in the future and can participate and get get a part of that and participate in the growth. So as you grow that company to 100 and 200 million over time, you get to reap the reward of that effort is really the construct, and it gets everybody excited to getting to the same place. And so we like to point this out because there's a lot of business owners that don't realize that this opportunity exists for them. They are often there's a perception, I should say, that, well, if I sell my business, that means the next day I'm out in the street and, that's it. And it's actually not the case. Kind of back to that, what's in it for me and what do I want? If you want to stay on, that can be established. If you want to help grow this business over 5 and 10 years and get to 200 million and have a meaningful stake in that, you can structure it that way. There's a lot of options, and every group has different structures and ways to do that. But the opportunity is there. So we always like to educate and make sure folks are aware of this being an option for them.
So this is kind of where the rubber starts meeting the asphalt, you might say. Dina did a great job of talking to you about your needs and your wants. And do your needs and your wants line up with the value of the business that the market is willing to pay? And for most people, as a former business owner myself who just exited in April of 19, I got to say, I never really knew what the true value of the company was. And so I think one of the opportunities here is for you to start working on that and understanding it. Now, it's going to start with your EBITDA. And that's going to be a place where you're going to be able to determine what your bottom line is with the business. However, there's other things that have got to be added into that mix. Most importantly is the mix of your business. Is it a residential business? Is it a commercial business? Is it a residential construction or installation business? Is it a commercial construction? What is the strength of your team and your leadership? What is the strength of your systems and processes? What's the geography that you cover? And do you have a customer base that's already set up on annual reoccurring service agreements? All of these things bring additional values to the business, or sometimes can actually devalue the business a little bit. And on top of this, you're going to go through a process in which you're going to have add-ons, which is the amount of money that you as the owner has been taking out of the company on an annual basis, and that at the time of the transaction and post-transaction, that money will no longer be coming out. Maybe you've got a couple of your family members on salary. Maybe you do some stuff at your home. As business owners, we all are doing different things, and you should be, and nobody looks negatively down on that. So you don't have to try to prepare yourself for this. Just know that you're going to get the opportunity to add those back to your EBITDA, which just increases your value. And then you've got to look at this whole component around the idea of your mix of business that I was speaking to. I want to give you an example. So a residential HVAC that's dependent upon new construction is not going to be as valuable in the marketplace as a residential HVAC that is servicing single or multifamily home installations. Companies with strong maintenance contracts that I just spoke to a little while ago, Those are always going to increase your value because that is reoccurring revenue. And industrial mechanical contractors that have heavy concentration in service are going to be more valuable than those that focus on construction and installation. Just always know it's important to determine this value and get with advisors that can help you be able to work on that so that you can match up the value of your company to your needs and expectations.
So well said. And one of the questions that we're asked often is, right off the jump, well, what am I worth? What are multiples in the market? How does that apply to me? And, what Jeff is really articulating here is it's not a one size fits all. Every single one of your businesses is unique. There's only one like you. And I always say that, the widget in the middle, whether that's a product or a service, and obviously in the case of everyone on the line here today, that's a service. That service is only as good as the people, the process, the technology, the culture, like all the things that surround it, all the things that you've put into your business over the years to make it great. And so you can't just slap a price sticker on it and have it encapsulate all of those things, and that's why it's really important to just comment at the end, and why I want to stress it is, you really should get with advisors who can give you more perspective on how those intangible attributes are being looked upon by the marketplace. We gave some examples here today, but it's certainly not an all-inclusive list. For everything that devalues, there's things that add value, and so it's really important to sit down with someone and talk through all the components of your business, and then look at what the market has to bear for it, and then pair it with your personal needs and make sure that it meets. So we've talked about value, but now we need to talk about terms. I tell every single company that we work with that there is so much more to a transaction than just the price, than just the sale price. Now, of course, it's a very significant data point there. However, the deal that has the highest price may not be the right deal. It's really important to find the right deal. That's why asking yourself all of those questions about what do you want to come out of it, it's really important to be vulnerable and to answer those in a really meaningful way, because that dictates what's right. And so from there, the terms and the conditions. So I always say that valuation or the price is the what, and terms and conditions are the how. It's how. How does the world work after this transaction closes? How is the money paid out? How is the buyer funding this transaction? Are they paying cash straight out of their bank account and it's pure equity? Is it a leveraged buyout? Is it some combination of the two? How is that happening? How and when is the money paid? There are many things to consider. There's many different ways to do this. We've seen transactions across a broad swath of types of companies, and we've seen so many different ways. But sometimes it's not 100% at closing. Sometimes there's things called earnouts that are contingent on performance. There's a seller's note, or a stock, or other types of deferred compensation. And if you're not familiar with what those are and how they operate, it can be really confusing to understand, like, is this good? Does this align with my personal needs? If I'm looking to retire and I want to leave 6 months to 12 months after, but I've got a 3-year earnout, does that align? Does that line up with my wants and needs? Probably not. Maybe it does, who knows? But those are the types of questions that you have to ask and really look at. And that's where terms and conditions can really make or break things. And then there's the devil's in the details, right? It's all of the things like indemnification and liability and representations and warranties. These are big words that really all boil down to you asserting that what you're selling is in fact what it is, and the buyer asserting that, hey, listen, we are doing with it what we have articulated to you that we are going to. We're representing this to one another. We'll warrant and carve out your liability around certain things. it's a minefield to manage through if you don't have someone advising you through the process. You know, good M&A attorney is really important in these transactions. I can't stress that enough. I mean, there's many great business attorneys or estate attorneys, but they are traditionally not M&A attorneys. It's really important you know, to have a really strong attorney and advisor that can help you navigate this, because it's a lot. And it's emotionally tinged too, and so you have to kind of have folks who can help you step away from that emotion and, you know, get through these and understand these so that you know exactly what to expect. Because as we all know, nobody likes to be surprised, and so terms and conditions are where people often can be surprised. Well, I didn't know that. What does that mean? Well, no, that's not what we agreed to. Those types of things pop up, and that's where things can go sideways. And what you thought was a great deal isn't. And so it's really important to over-communicate on these things, to solve for them as early up front as you can, and understand what they are. So we'd like to make sure that we point this out so that for those of you considering something like this, just know that there's also other things that we have to consider in and above the valuation. And then we move to everyone's favorite topic, due diligence. And this is really, you know, the part of a transaction where the buyer is making sure that what they're buying is in fact what they're buying. You know, making sure that all the assets are as reported, that, you know, the customer relationships are strong, and that the management team and the employees are strong, and they really work through all the key components of the business and just make sure that everything you know, is status quo. And we'd like to highlight this because it's really important to be prepared. If you go into a process and you haven't prepared for this, it makes it far more difficult. And it creates a perception. You know, when I was young, I had someone say to me, you know, perception is reality. And I remember being frustrated with that. I was like, well, but it's not the truth. But, you know, perception becomes truth. And so if you're not prepared, it can create a perception that inadvertently that something is wrong, that it isn't what it seems. And again, back to my comment about people don't like to be surprised. This is where things, they become surprised because they find things they didn't know about, or you didn't tell them about something, or you weren't sure about this or that, or you didn't have those records, so you can't really prove that. And so it just creates a doubt inadvertently. So it's really important to be prepared going into a process. That, you know, includes getting your financials in order. You know, this is an area I know a lot of business owners tend to neglect because they just look at the cash in the bank. Like, if the cash in the bank is great, and I just kind of keep going month to month. And that's certainly a way to do it, but it's not enough when you want to go through a process like this. So I can't stress enough, you know, if you don't have a controller or a CFO, there are many great organizations out there where you can hire one on a fractional basis, or, you know, a part-time basis, a contract basis. They can come in and help you get that all pulled together. You know, your legal documents and your critical records, making sure that you have all of those easily accessible and that you understand the terms of all of them. You know, employment and human resources, you know, all of it, regulatory and compliance. That's another area oftentimes where things get overlooked. Like, you know, have you done OSHA filings? You know, have you been filing? You know, has all of that been kept up in the cadence that's supposed to? Insurance, are you underinsured? Sometimes your business grows so fast that you don't realize maybe that you might be underinsured, so you need to mitigate that. So there's just many things that you have to prepare for. And that's why it's really important to have an entire deal team, as I mentioned before. You know, a good advisor, a good M&A attorney, a CPA, both a management CPA who can help with your internal bookkeeping, and then even it can be the same person or often separate, a tax CPA, so you can talk through taxation things. But by being prepared, it really it makes sure that everything is transparent. There are no surprises. When there's surprises is when deals often get retraded. So I think, you know, many of you have probably heard horror stories of, you know, someone gets an offer, but what they actually close on 3 months later is something completely different than the initial offer, because things were discovered through due diligence. And so, you know, that's no one likes to have that happen, and most acquirers and investors don't want to do that. They want to close on the offer that they put forward, but sometimes it's just what happens. And so, and oftentimes when deals get retraded, they often fall apart. And it can be prevented if you put the time into it and are prepared from the beginning. So to summarize today, timing is everything, and the time for HVAC M&A is now. The market is really strong. We hit that at the beginning. Demand for assets is high. There's a lot of competition and a lot of great acquiring corporations and investors. We had someone in the chat mention to us, and it's a good point that I want to make sure I hit on, is that that second bite of the apple is not unique to private equity. It's also, there are strategic corporations who are doing the same as well. So I didn't want to necessarily just strategize that was the only thing specific to PE. It is broad across acquirers in the market. But that second bite is a great opportunity. There's a great earning opportunity and growth opportunity for your business. The terms are really strong right now. It's a seller's market. So you are today very well positioned to get the terms that meet your needs. And you're in a position where, timing right now, you get to be proactive. You get to go out and determine what you want versus reacting in the future to a trigger event. And unfortunately, trigger events tend to be not positive things. And so, flip that script and be in the driver's seat and be proactive and go out and get what you want. Again, valuations are really strong. We are seeing some really, really strong high valuations for good businesses. Our firm in particular has had some recently that we have seen, which is why we can speak to it ourselves, that are extraordinarily above market. So it's really strong time. So all of us want to cash out on the top, right? And so keep that in mind as you're putting your strategy together. And then lastly, we touched on this competition. As the industry consolidates, your direct competitors will now be well funded by corporations and financial investors. And so organic growth for your business is going to be harder because you're going to have to compete with the deep pockets of those organizations, to keep and grow your market share, which is harder to do because you don't have as many resources. So the sum of this is that it's a really great and strong opportunity for HVAC and contracting business owners. So really encourage you to think about it and put a strategy together for yourself, whether it's now or in the future. But hopefully this information that we shared today will really help you in determining what that strategy needs to be for yourself. And so that's it for the deck itself. And so we're going to open it up for Q&A here. And so Terry, I can toss it over to you. I'm starting to see questions pop through the Q&A queue here. So
yes.
Excited to chat through them.
Yes, great. Thank you and Jeff for a really fine presentation. And I do see some questions coming in. It is a personal request for a contact, but so I will not ask this one, and you will see the person's phone number there. But there is one here. What is the range of valuation multiples for above average performing companies?
That is a great question, but it's a loaded question. So, back to our earlier comments on valuation. In HVAC specific, it really is ranging extremely broadly because the size of companies in the industry vary broadly. So, what we're seeing is lower valuations for smaller businesses. Those are trending anywhere from 3 to 6 times. For larger businesses, in specific demographics, we're seeing anything from 5 times to double digits, and mid double digits. And I'm not being exaggerative. Those are tangibly valuations that we've seen and touched ourselves recently. So it is very broad. And the reason that they are so broad is because, as my grandma always told me, something's only worth what someone's willing to pay for it. And who that someone is going to be different, and what's valuable to them is going to be different than the person next to them. You know, if someone is really hungry for your geography, they're going to pay more for that because they've been dying to get into that geography and haven't found an opportunity. Or you've got a set of customers or services that they want to grow into and they haven't been able to find the right organization for, they're going to pay up for that. If you have a really strong management team or good technology or systems or processes, they're going to pay up for that. So, you know, we're seeing the range very broad. So like I said, anything from 3 times to double digits. You know, I would say things kind of average, you know, back to the prior visual with some recent acquisitions, you know, those are ranging anywhere from 5 to 8 times. But again, you know, especially for those who are on the phone who are acquirers, you know, certainly not trying to speak specific to, you know, to what folks are paying. These are really just, you know, ranges, and it's all going to vary and dictate on the specific characteristics of your business, which is why it's important to talk with someone, with an advisor who can help really hone in, because it's really hard to answer that question without knowing, as Jeff was talking about, all those different parts and pieces, you know, because when you're talking 3x to double digits, it's a really wide range, and that's a material swing, and so we don't want to speak out of church and peg something, you know, the wrong way.
All right, thank you. Here's the question. What percentage of the transactions you have been involved in have the owner or owners staying on board for a period of time?
That's a great question. I would say what we are seeing is probably 60 to 70% of the time the owner stays on for a period of time, and, you know, maybe 30–40% they are exiting, you know, shortly thereafter. It really, I would say I can kind of bucket it into 2 buckets. You know, those who are looking for retirement and are ready and are done. You know, those are the ones that spin out more quickly after close, and then the others want to stay on and help grow. You know, are really interested in that second bite and want to be a part of executing on that. But we are seeing in most cases where the owners are staying on. So I'd say 60–70%, and maybe a third to maybe 40% are churning out.
All right. William asks, what is the range of valuation multiples for above average performing companies?
Yeah, I think we were just chatting on this a moment ago. You know, the range can be very broad. You know, above average performing companies, you know, they're commanding the higher end of that range. We're seeing anything from, you know, 5–6 times to 10, shoot, even higher than that. And so it varies widely, again, back to some of those key characteristics that we were honing on that people will pay up for, but they're tending to trend towards the higher end of the ranges that we've been talking about today. And then there was a question from Brad here about, are the multiples you're referring to multiples of revenue or EBITDA? Thank you for asking that qualifying question. That's something I should have articulated from the beginning. Those are multiples of EBITDA. Most investors, that's where they start. They start with EBITDA. And for those who don't know what EBITDA is, it is essentially your operating income. EBITDA stands for earnings before taxes, interest, depreciation, and amortization. And so that's where you start, and then from there, you know, it's adjusted for the intangibles that we talked about that.
All right. What are your suggestions for non-compete arrangements from the perspective of both the buyer and seller?
So non-competes are just something that happen in every transaction. You know, if you're selling your business to someone, they don't want you to set up shop down the street, on the day after you're not working with them anymore. Because HVAC and contractor-based businesses are very fragmented, there's always a desire and a requirement by buyers for that to happen. In terms of suggestions, we usually find a reasonable balance, understanding that the buyer needs that risk protection, but at the same time, the seller can't be beholden to a egregious non-compete. We normally see non-competes range anywhere from 2 to 5 years, probably more often 5 years, and they're usually geographically defined. That geography is defined in many different ways, but it's usually time-based and geography-based, within a certain range of miles of operations and things of that nature. It is something that will happen in every transaction, and so the best is to just make sure that it's lined up well with your tenure and your plan in terms of how long you're going to stay on, and making sure that it gives you the autonomy. So if you end up consulting in the future, doing individual investments, you're not in breach of your non-compete of your contract.
All right. What is the percentage of cash paid at closing in an average transaction?
Ooh, this is one of my favorites. We are seeing right now 100% cash at closing a lot of the time. In instances where there's a deferred component, it's usually maybe 20%. But the reason I say that, acquirers and investors prefer to, if the risk qualifications of this particular company meet the criteria, but assuming they do, the acquirers like to pay 100% cash at closing. Well, why? Because it kind of puts the transaction in a rear view mirror. It allows these now new partners to just be focused on growth. When there's deferred compensation in a transaction, it creates a measurement point. It creates a point in time in the future where attorneys have to get involved, and you have to certify that X equals Y, and not that that's bad, but it does just sometimes enter some awkwardness. And if there is an issue that has to be dealt with, it can have a relationship ramification. So we actually see the acquirers prefer to be able to pay 100% cash at closing. In HVAC deals, we are seeing that be the norm. Where oftentimes, though, we see it not be the norm, and sometimes it's that 20% that is paid behind, it's because there's usually something in the financials that dictate it. There's some volatility in the numbers, or there's some expenses that are going to take some time to right size, and so that's oftentimes, or there's some risk, or for those of you who are B2B commercial HVAC, make sure you're collecting that AR. Go get that money. That's often one of the things that becomes a subsequent deal point that sometimes requires money to be held behind. But I would say overall, most of the time, we're seeing 100% cash at close, and then when we're not, we're seeing 20-ish, 25% being held back in some form of deferred compensation.
All right. Is there a different view on valuation for a tuck-in that is based more on revenue and gross margin versus EBITDA?
That's an excellent question. And I think, I know my kind of common response has been, it depends, but I would say overall, yes. Often tuck-ins are operationally focused. But that being said, they can't be unprofitable or have some issues. But really, if the revenue and the gross margin is there, and the volume and the demand from the customers is there, and you're in a good geography, that's a big box to check in terms of a tuck-in. So the short answer is yes. Yes, but but if the reason the business isn't maybe necessarily as strong from an EBITDA perspective, if there's some issues in there from an operational perspective that are driving that may devalue it a little bit. It just depends. But I would say overall, yeah.
All right. Can you speak to general trends in deal structure, that is to say, percentage of cash at closing versus earnout or other structures?
Yeah, Sure. It's kind of what we were just chatting about. We're seeing a lot of 100% cash at close. Actually a deal trend that we are seeing more often is the concept of representation and warranty insurance, R&W insurance. And a lot of acquirers are using this in their transactions because it allows for all those reps and warranties that I was talking about before, the promises. That's really what they are, promises that you're making to one another. If one of those promises ends up not coming to fruition in the future, there could be, some litigation around that, and nobody wants that. So what R&W insurance does is it protects it. You buy an insurance policy and make sure that if something like that happens, the policy can cover it. And it allows buyers to close deals faster. It allows for there to not be so much of that deferred compensation, like earnouts or escrows or things of that nature, because both parties are protected under this policy. And the policies are becoming more and more inexpensive. Early in the years, it was really expensive to have that. Now, the carriers are, especially specific to this industry, because there's so much deal activity happening, they're doing that. So that's a really interesting trend, and one that we're seeing by a lot of acquirers to be able to get deals done more quickly, but still be protected from a risk perspective. And as a seller, it's a great thing to have, because it takes that pressure off. There might be some future issues or some liability or some things that you just don't know, because it's hard to know every single thing about your business in that 1 second. So that's a trend that I'm seeing. But overall, in terms of structure, most of the time it's 100% cash at close. In instances where it's not, it's usually an earnout that's based on performance, and those targets are set as a part of the transaction by both the buyer and the seller. They have to agree to those targets going forward.
Great. Well, thank you. Well, that's all the time we have. If your question was not answered, you will be receiving an answer. And I would just like to thank our presenters, Dina and Jeff, as well as our sponsor, Align Business Advisory Services. I'd like to remind listeners, and thank you listeners for your questions, the webcast on-demand version will be available on the Contracting Business website for 1 year. The link to the recording will be sent to you by email in the next 24 hours. We thank you so much for attending, and have a wonderful remainder of your day.